everybody, and good morning. Thank you for joining my segment. For those of you who are watching, my name is Richard Ciuzio, and I am a loan officer with Hudson United Mortgage. I am licensed in the states of New York, New Jersey, Connecticut, and Florida. And today I wanted to talk to you guys a little bit, guys and girls, a little bit about conventional versus investment properties and the financing and what comes into play when you're trying to get approved for purchasing these houses or condos or whatever they may be, these properties. So that being said, if you ever want a free consultation or are in the market yourself, you can always reach out to me day or night. I'm usually pretty responsive and available. And my cell phone number is area code 321-634-2552, or you could send me an email at richard.ciuzio@hudsonunited.com. That's CIUZ like in zebra, IO. So that being said, let's jump into today's segment. Investment properties, they can yield years of rental income, and they can most certainly diversify your portfolio. But getting a mortgage to purchase an investment property is a little bit different than getting a mortgage on your primary residence. Different home loan programs can be used to purchase an investment property. You can do a conventional loan, which is probably the most common choice among buyers, especially if you have the assets and income to do so. However, you can also do a VA loan, which is a veteran's loan. You can do an FHA loan, which is the Federal Housing Administration, or you could do a USDA loan. These are government loans, which is a low interest bearing loan, the USDA. Keep in mind that these requirements for getting these types of mortgages for an investment property, they vary considerably depending on the chosen program. So let's take a look at what you can expect when you're financing a property. All right, now some of this information, is up here, but I did also outsource some of my information to from One American Mortgage on their website. They had some very good, useful information, and some things that actually taught me a couple of things as well. So I just want to give credit to that where credit is due. That being said, when you're buying an investment property with a conventional loan, they usually conform to the guidelines by either Fannie Mae or Freddie Mac. Many people use conventional loans to purchase their primary residence, whether it's a single family, condo, co-op, whatever it may be. But this type of financing can also be used to purchase your investment property as well. Now, for those of you who don't know what Fannie Mae and Freddie Mac are, let me take a second and go into that. Fannie Mae is the Federal National Mortgage Association, and Freddie Mac is the Federal Home Loan Mortgage Corporation. These two entities were created by Congress, and what they do is they perform an important role in the nation's housing finance system. They provide liquidity, stability, and affordability to the mortgage market. They provide liquidity to thousands of banks, savings and loans institutions, and mortgage companies that make loans the loans to finance your housing. They buy mortgages from the lenders and either hold these mortgages in their own portfolios or packages, and then or package their loans into their mortgage-backed securities, your MBS. MBS is mortgage-backed securities. That's how which also goes hand in hand with the interest rates. Lenders use the cash that is raised by selling these mortgages to the enterprises and engage in further lending. So these enterprising purchases help ensure that the individuals and families that buy these homes and investors that purchase apartment buildings or multifamily dwellings have a continuous, stable supply of mortgage money. Now, by packaging mortgages into the MBS or mortgage-backed securities and guaranteeing the timely payment of your principal and interest on other underlying mortgages, Fannie Mae and Freddie Mac attract to the secondary mortgage market investors who might not otherwise invest in mortgages. Thereby, they expand their pool of funds available for housing. So Freddie Mae and Freddie Mac can also help stabilize mortgage markets and protect housing during extraordinary periods when stress or turmoil in the broader financial system threaten the economy, hence COVID, or like we had last year. I mean, when COVID came out, rates dropped just substantially. We had the lowest interest rate market uh, probably in history, or the first time in at least 40 years. We saw rates as low as 2.25%, 2.5%. At one weekend, I even saw a company offering a 15-year product at 1.99%. I mean, that's how low the rates got during COVID. I hate to say that turmoil actually helps interest rates and the mortgage-backed securities, but it does. When you're looking at the interest rates and you want your the market to improve, you want natural disasters, you want COVID, you want things of horrible proportions to happen. I don't why it happens, I don't know, but the worse things are out there, the better your interest rates are going to get. The better things are in the world, then your interest rates are going to go up. As of right now, currently we are back to pretty much square one, from where COVID, before COVID, pre-COVID. That's where rates are now. We're in the low threes, high twos, low threes, depending on the type of product, credit score, loan to value, all that good stuff. So that is Fannie Mae and Freddie Mac. Now back to your investments. When you're buying an investment property with conventional financing, um, you'll obviously need to provide the same documents as you would a conventional loan. We'll need your 2 years of your W-2s and tax returns. If you're a self-employed borrower or not self-employed, or if you have rental properties, we definitely need your tax returns for that. We'll need 2 months of bank statements to verify your assets that are going to be used for your down payment and closing costs. And obviously, we'll need to validate your residency, whether it's by U.S. passport or driver's license and or green card. And we also have to run a credit check on you too. So there are different types of investment properties that you can have. You can have a single family, a multifamily, whether it's 2, 3, or 4 units. All of those can be used as an investment property. Heck, you can even use a 4-family home as a primary residence. You could be living on the bottom floor in the first unit and rent out the other 3 units. So it could be a primary residence, even though you're collecting rental income on it. However, if you have your own primary residence over here in North New York, and you have a 2-family home or 3-family home in Southern New York, that you can most certainly have more than 1 unit on an investment property. 1, 2, 3, 4 is you can have a co-op as an investment property. You can have a condo as an investment property. Maybe you were a bachelor and you bought a condo when you were young, maybe like 25. And then you met the woman of your dreams or the person of your dreams, and you decided to move out, expand, get a bigger home, raise a family, get the dog and cat, the whole kit and caboodle. But you didn't want to get rid of your condo, didn't want to sell it. Now you're renting it out. That's an investment property and it's a condo. Now the condo is paying for itself, and all you got to do is worry about paying on your mortgage, and maybe you're making a little bit of money in the process. So you can definitely have more than 1 unit to a investment property. But just because you're buying an investment property, the guidelines for an approval aren't as lenient as those for a primary residence. So for example, when you're qualifying for an investment property, typically the lenders require a higher minimum credit score, but when you're applying for a primary residence, you can go as low as a 620 on your FICO score. However, with a investment property, you're probably going to want something above 680, but they do range from 640 to 680. But obviously, the higher the credit score you have, the better the rate you're going to get on your fixed rate mortgage or your adjustable rate. And obviously, the number of units of that property are going to come into play as well. Another difference when financing an investment property is that you will pay a higher interest rate. This is because investment properties pose a greater risk to lenders than a primary residence. All right. Interest rates on owner-occupied loans are about 3/8 to 5/8% lower than an investment property loan. In translation, This means that an investment property loan may come with a slightly higher interest rate that costs you more for your monthly payment. You should also prepare for a higher down payment when you're doing a conventional loan and a larger cash reserve when purchasing an investment property with conventional financing. What are reserves? Reserves are your principal, interest, taxes, and insurance. Those are your reserves. Now, sometimes the lender is going to want 6 months or 12 months. So, depending on your FICO score, depending on all the parameters of your loan coming into play, you might need a 6 or 12-month reserve basis, which means you need 6 or 12 months backup after closing costs and down payment of your principal, interest, your taxes, and insurance. The minimum down payment for investment properties on a conventional loan, they vary. They're usually anywhere between 15 and 25%. However, as of recently with COVID and everything else going on, I haven't seen an investment property on a conventional loan go lower than a 20 to 25% on their down payment. Now, the only good thing about that, I mean, one, you're getting a lot more equity right off the bat when you purchase your investment property, but two, you're not going to be paying your private mortgage insurance because you're paying more than a 20% down payment. So, all right, no more questions on that one so far in the chat. Hope I'm not going too fast for you guys. Now, let's move on to an FHA loan, the Federal Housing Administration. These loans are for the purchase of a primary residence as well as investment properties. There are two ways you can use an FHA loan to purchase an investment property. One is to purchase the one unit as a primary and rent out the other units, like I said, or you can purchase it strictly as an investment property. The good thing about an FHA loan is you can actually do an investment property as an FHA loan and put as little as 3.5% down. So you're putting a lot less down payment. Maybe your income and assets aren't as luxurious as some of the other investors out there, and you need a program that offers a low down payment. So 3.5% is as low as you can go on an FHA loan, whether it's your primary or investment property. However, you are going to be paying your PMI. And unfortunately, with FHA loans, you pretty much pay PMI throughout the entirety for the entire loan life of your loan, whether it's 15 years, 20 years, 25 years, 30 years, whatever it may be. You're going to be paying PMI unless you do a refinance and get out of that program and eliminate your PMI. Otherwise, you're going to be paying it. Now, unlike conventional financing, which has stricter requirements for investment properties, FHA requirements for building a multi-unit home are somewhat of the same as a single-family home. Now, you can have as low as a minimum of 580 on your FICO score with that 3.5% down payment on the FHA loan. However, you can, if it's lower than 580, let's say between maybe 500 and 579, you're going to need to put a little bit more cash down, about 10%. So you're going to be paying your mortgage insurance, just like I said. Your debt to income ratio is going to come into play with this FHA loan too. If you have a low score, usually under 680 with these COVID overlays, your debt to income ratio cannot exceed 45%. And I literally mean 44.9. If you go up to 45, you probably will not qualify. I've dealt with this before. I've had this happen recently. You want a good FICO, folks. Anything above 680 to help you stay away from these COVID overlays. What is your debt to income ratio? Those are your monthly expenses divided by your monthly income. That's your principal, your interest, your taxes, and insurance, plus any other debt that you might have: credit cards, auto loans, student loans, car payment, boat payment, whatever it may be. It's all your installment and in revolving debt. You have to keep your expense ratio under 45 if you have a low FICO. So let's talk about VA loans and buying an investment property. All right. PMI, just so you guys know, is private mortgage insurance. In case I didn't clarify that, before I move on to the next segment. It is insurance that strictly protects the lender, nobody else. It's completely irrelevant to any buyer. It's a, as I was taught when I was working retail banking, it's a farce, which is why the bank I used to work for before I came to Hudson never had PMI on any of their products, because it didn't do the borrower, the buyer, any good whatsoever. So if you can avoid paying PMI, so be it. However, you know, some people are income handicapped and need loans like the FHA so they can qualify for a home, have a lesser down payment, and a lower interest rate. Um, so that is what PMI is. It actually does no good to the borrower whatsoever. And I try to avoid that at any cost when I'm doing a loan for my borrowers. Um, now the good thing about conventional loan versus the FHA loan when it comes to PMI, even though you're paying PMI throughout the entire life of your loan with an FHA loan, even if you put less than 20% down payment on a conventional loan, as soon as your loan to value reaches 78%, which means through the years as you're making your mortgage payment and you accumulate 22% equity in your home, which 22 from 100 equals 78, your PMI is automatically removed on your next payment. Automatically. Boom, done, goodbye. You don't have to pay PMI anymore once you reach 78%. So that's a good thing when it comes to conventional loans if you're putting less than 20% down payment. With the PMI, you will have to pay it because you're putting less than 20 down. However, it gets removed once your loan to value or your equity becomes 78% or 22% equity or 78% loan to value, however you want to calculate it. It's automatically removed. That is a law that it's automatically done. So VA loans, when you're buying an investment property with a VA loan, the requirements for using a VA home loan for an investment property, they're kind of similar to the FHA guidelines. You can only use a VA loan if you purchase a multi-unit property and reside in one of the units for VA. So you have to actually live there. If you buy a 4-family property, you have to live in one of those 4 units. Okay. Um, if you purchase a single family property as your primary residence, you can certainly rent it out at a later time. However, with the VA loans, I know that there's no down payment. You're not paying PMI. That's some of the benefits that the veterans get. One, for providing service to our nation. But two, I know that you can, in order to get those same benefits the second time around, if you buy a second property, you have to have no mortgage on that. You have to pay it off. You can have more than one VA loan going on at the same time, but you're not going to get those same benefits from your first VA loan as you will on your second, unless your first mortgage is completely paid off. So properties that are eligible for your VA benefits, those include with 2 to 4 units, you must meet requirements set by the VA. You'll need to present your certificate of eligibility and your DD 214. These are your documents. These are your military documents that we have to get to see if you're eligible for the VA product. And we want to see what service you were in. Were you in the what branch of service, how long you served, so on and so forth. Were you in the Army, Navy, Marines, Air Force, Coast Guard, National Guard? Are you in the reserves? All that stuff comes into play. So this type of program is available to veterans. It's available to active duty military, reservists, Coast Guard, National Guard. It's even eligible for surviving spouses of an eligible service member. So if you didn't serve, but your husband or wife did, and they're no longer with us, you can qualify for a VA loan as well. Now, a VA loan requires a credit score of 620 or higher. There are a lot of good benefits for VA loans. In fact, I should probably do a segment on this now that I'm thinking about it next time around. 620 or higher, and the debt to income ratio is 41%. It has to be under 41. It's similar to buying a primary residence. However, you can also purchase anywhere a multifamily home for 2 to 4 units with 100% financing. That means no down payment. 100% financing means no down payment and no PMI, no private mortgage insurance. Those are some great benefits that I think every veteran should take advantage of. Absolutely. So now we can go on to um, buying an investment property with the USDA loan. All right. USDA loan is for the purchase of a primary residence, but also can be used for your multifamily home, and it can actually go up to 5 units. However, I only do 1 to 4 family. I think 5 units and above is technically a commercial loan. The minimum score to qualify would be a 640, but you also must meet the other program requirements too: employment, income, assets, um, all that good jazz. Everything, the same thing that was the FHA loan as well. The monthly rent on a USDA loan cannot exceed 30% of the 115% median income for the area. So it is income restricted. You cannot, if each area is segregated into different income zones. Westchester, like for instance, New York, Westchester County, Putnam County, Dutchess County, Orange County, Rockland County, they each have like an income roof that you cannot exceed when you're doing certain loans like this. So in this case, it depends on what geographical area you are in, but your monthly rent cannot exceed 30% of that 115% monthly cap income. That makes sense. It's a little confusing, but it is income limited. Um, to qualify for your debt to income ratio, or to qualify, your debt to income ratio cannot exceed 41%, just kind of like the VA loan. And your mortgage payment for the property shouldn't be more than 29% of your gross monthly income. I have not actually done one of these loans yet for USDA. I've been primarily FHA, um, VA, and conventional loans. But this, if you qualify, this is a good product, and it has low interest as well, which is a good thing. Um, Let me think if I can think of anything else. Now, here's a good tidbit as well when you are purchasing an investment property. You can use proposed rental income, proposed market value rental income, when you are purchasing a home. Okay. For instance, I'm going to buy a 4 family house. I'm going to finance a 4 family house. I want to get a mortgage for 30 years. I'm going to rent out the other 3 units, and I'm going to live on the first floor. Rent out floors 2, 3, and 4, whatever it may be. You can use the proposed rental income for that market at that time as income towards your mortgage to help you qualify. If you don't qualify solely on your income alone and your assets, you can use your proposed rental income. However, on an FHA loan, it gets a little tricky. Your mortgage, your monthly mortgage payment, your principal, interest, taxes, and insurance, it can't exceed your you can only use 75%. It can't exceed 75% of your gross rental income, or the other way around. It's a little tricky. You are capped, so you have to make sure that you're not trying to use gross rental income when you're applying for a 850, $900,000 home, because um, chances are you might not be able to use it depending on what the market value is, and how much your monthly payment's going to be based on your interest rate, loan program, FICO score, geographical location, all that, all of those criteria combined. Um, Honestly, I think that's all I can really think about or talk about at this time that's coming to mind. So I'm going to open it up. If you guys have any questions, feel free to put it in the chat. Phil or Oscar, if you guys are there and you want to ask me something, feel free, and take it away. And guys, thank you again for listening. For those who did tune in, if you want to get a hold of me one more time, my phone number is area code 321-634-2552. And you can reach me at richard.ciuzio@hudsonunited.com if you want to send me an email, and I'll be more than happy to answer any questions or get you pre-approval, whatever you need. Take a look at anything. Okay. Thank you.
So the one thing I took away from this is there are a lot of moving parts, and people should really sit down with you one-on-one so you can go through which one of those fits best into what you want to do. That's how,
Right.
I'm hearing a lot of different scenarios. And one of the questions was, can you use a multifamily house as a primary or as an investment? And you answered that you very well could. And now it becomes the individual. Well, like you said, are you going to live in that and call it a primary while you also have another primary? That gets into the woods.
Well, for you, I mean, just I'll take you for example, Oscar. You live in a 2-unit house. You have a primary home, and you have a 2-unit house. Now you're not renting it out, but your mother-in-law lives upstairs, and she's paying her portion. That is so. Yes, the answer is definitely you can have a multifamily house and call it your primary residence, but you have to be living in one of those units. Now, there are a lot of players out there in the market, and I'm learning this as I am doing more and more deals. Here's what happens when you guys have an investment property that you, let's just say you do a refinance and you move into your investment property. Um, and then you have another property that you want to refinance as your primary. You cannot, if for some reason within a 6-month period you try to claim two different primary residences and do a mortgage on them, whether it's a refinance or a purchase or whatever it may be. One, you have to have very strong, um, you have to have documents. You have documentation of everything, whether it's a cable bill, utility bill. You have to have proof that you're living there for X amount of time. But if they find out that you are fraudulent in any way, shape, or form, the bank will buy back your mortgage and will take your home from you. The person who did your loan, whether it's me or somebody else, will be, I'll probably lose my license, and the company they work for will be liable for any fees and penalties associated with the fraudulent activity on your home. So
There's a high price to pay for that.
there's a very high price to pay, and I'll be honest with you, I'd rather not lose my job over something as simple as a 0.25% on an investment property versus a primary residence.
Yeah, so for somebody that wants to get involved in investment properties, what would be your primary advice to them?
Have substantial income and assets and be prepared to pay. Look, if you're not going to, if you don't have the 20 to 25% down or some renters lined up, then I would suggest looking into the FHA loan, which is a great program. You can put as little as 3.5% down. Make sure you have very good credit, 680 or higher, and be prepared to, depending on the amount of your home, the purchase price. Look, I've seen PMI as much as $500 on homes before. That's how high sometimes your private mortgage insurance can get. That's why I try not to recommend paying mortgage insurance for FHA loans, because on a $600,000 home, that's $500. I mean, that's your insurance monthly payment 3 times over, if not more. That's how, I mean, $500 is a lot. That's my car payment, man. That's a lot of money.
Right.
I'd rather take that $500 and put it towards my principal balance, and just attack principal and get more equity in my home a lot faster. But for those who are investing, look, um, we have great products for those who are investing. If you want to flip houses, if you want to renovate, we do renovation loans. I can do a segment on that in the future, maybe next month or the month after. I would love to talk to you about that.
Absolutely, yes.
Buy cheap, renovate, and rent it out. Have the assets, have a good credit score, and just be on the up and up. That's all I can say. We don't. They're not going to lend to anybody, but we're going to do our due diligence in order to make sure that you can qualify and are a good borrower.
Yeah, I mean, because like next month we're going to be talking about entrepreneurship and be encouraging people to do their own thing and pursue their dream. And so if you're interested in becoming an invest in real estate, that you plan to make that a field that you want to specialize in. These are some great tips and points that you're giving, you're putting out there, Ricky, and I think it's essential for them to know that. But what are some of the biggest mistakes you've seen that people make in trying to pursue that from the loan perspective?
What are the biggest mistakes? I would have to say some of the biggest mistakes are opening new lines of credit during the loan process, closing existing lines of credit during your loan process. Because if the loan process exceeds the time that we really want it to be, the time that it takes to close, within 90 days, your credit report is going to expire. We have to run credit again. If you've closed credit or open credit, you're probably going to have a lower score than what you started. And guess what? If you jump from a 720 to a 719, that 1 point makes a difference. It literally does. I had a client who was paying off her credit cards one by one. At the time that I did her loan, she was at a 718 FICO score. She was also in forbearance. She got out of her forbearance payment program, right? And I had to run a new credit. I wanted to run a new credit report to get that forbearance off her credit. She
Right.
jumped from a 721, from a 718 to a 721, and got an 8% difference better on her interest rate by 3 points. That's how much your credit. So don't open credit, don't close credit. Don't switch jobs. If you have a good job, please don't switch jobs and don't go to a lower paying job. If you're going to do anything, go from an hourly to a salary, because that's the easiest thing. A lot of times people will move around, they'll shift around, and it can hurt your DTI if because we need a history. We need to look at that history. And if you switch jobs in the middle, if you go from a salary position to an hourly position, we
Mhm.
can't use your
Or
we have
commission.
to, or commission. Commission's even worse. Commission, that's your deal's done, because you need a 12 to 24-month baseline of commission, and in order to qualify. So um, sometimes the realtor, I'm not saying all the time, but sometimes the realtor messes up on the taxes when they're doing their searches and they're putting the information out on the NMLS website.
Mhm.
Sometimes the taxes come back. I've had taxes come back $700-800 higher for the year, and if you're already strapped with your debt to income ratio, um, that extra $30 a month might make or break you. So there's so many factors. Every loan is different. Every loan is unique. So we have to treat it that way. Every customer, every buyer, every borrower, look, we, I take pride in what I do. I love doing what I'm doing, and I love
Mhm.
being able to help qualify people. Every person is unique. Every loan is unique. So I like to take the time to sit there and figure out what is best for you and what you're comfortable with. I'm not going to shove product down your mouth. I'm not going to make you go and do things you don't want to do. I want to make sure you guys are comfortable and are able to make your monthly payment day to day, month to month, year
Right.
to year, and be able to afford it and stay there until you're ready to move on.
See, that's what a good loan officer would do, right?
That's what a good one would do.
Do.
Yeah. Do
That's why
every
you
loan officer do that? No, but I'd like to.
The last group of people I want to ask you about are the people that work for themselves, right? They want to invest in a property.
Sure.
What do they need?
So self-employed borrowers need. I have a worksheet that I use to qualify the self-employed borrowers, but pretty much they need the same exact thing that a W-2 employee needs, minus the tax returns. The tax returns are the only difference between a self-employed borrower and a W-2 borrower, because we need to see what their business is making for as a self-employed borrower.
Mhm.
If if they've had if they've made more. So right now I'm using tax returns from 2019 and 2020. If the borrower has made, as a self-employed borrower, has made more than in 2020 than they had in 2019, then the basic rule is I can get away with using a 12-month scenario. 12
Okay.
month of their average income. If they've
Mhm.
made less in 2020 than they did in 2019, which, you know, is a very good chance because of COVID, but not, it doesn't qualify for everybody, then I have to use a 24 month. I need all of your tax returns, personal and business, and I need all the pages associated with those business returns, whether it's your K1, your 1120 S Corp, Schedule C, whatever it may be. Even there's like a small page on one of the sections that says see attachment. I need that attachment page too, because that tells me what has been what has been deducted. It also tells me what your W-2 earnings are if you're paying yourself as a W-2 employee throughout your own business. So those are the only things. You just need a 2-year history
2 years.
as a business owner. You can't come to me 6 months in. Oh, I just started a business, lawn mowing, blah 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 blah. Can I get a loan? Sorry, you need a 2-month history of any business in order to qualify. And we need all your need your business documents. Usually it's about 3 months of business bank statements and your two
Mhm.
years of tax returns, your personal returns, 2
Mhm.
years, and 2 months of your personal bank statements.
Right.
That we also need a P&L good through,
Profit and
you
loss.
know,
Yeah.
yeah, profit and loss statement. We need
Mhm.
that as well. It doesn't have to be audited because I know they cost money. You could do it yourself, but we
Mhm.
need one to match up to um, with the financials. So if you're closing in April, we need a P&L through April, January to
Oh,
April. If you're closing in
right.
December, we need one for 12 months.
Got it.
Yep.
Got got it. Got it. Got it.
Yes, sir.
You got great information, Ricky.
Thank you.
I think that this was very informative. For any of you who are looking to purchase a home, give Ricky a call. Let him run the numbers for you so you can see where you are and what you can do with that. His information is on the banner. If you want to give him a call, and also in the description, you see a link. You can click on that to set up an appointment with him. The consultation is free, right, Ricky?
Yes, sir. They can call me free at any time. Listen, I don't make money until the loan closes. Plain and simple. I'm not here
Plain
to,
and simple.
there's no other charges that are going to come out of your pocket until the deal closes. Plain and simple. So I am here with you 100% of the way, free of charge until that loan closes. And you guys don't even pay me. The bank does. So
There you go. Wonderful, man. Thank you. Thank you
you're
so much,
welcome. My
Ricky. And
pleasure. My pleasure. Anytime.
coming up next is going to be Karen Mayo. She's going to be making crispy squash, so
What?
or cauliflower. Yeah. So
What?
yeah. So we're gonna have a little bit of fun with that. So we'll definitely see you in Karen Mayo in the kitchen. Take care, everybody.
Thank you, everybody.